Hi, and welcome to Frank Talk on Mortgages. I'm Don Scott, the CEO of Frank Mortgage. Lately, we've been talking about variable rate mortgages quite a bit, and today we want to focus on the high proportion of borrowers in the last couple of years that have chosen variables and why they've maybe done that, and if you're one of those borrowers, what you can do about it. So historically in Canada, Canadians have been fairly conservative. Fixed rate mortgages have been the lion's share of the marketplace. As you can see in the data here in this graph, the blue line is fixed rate mortgages over time and the orange line variable rates. 70% or more of the market has tended to be fixed rate mortgages, and 30% or less has tended to be variable rate mortgages. And that changed in 2021, where variable rate mortgages increased rather dramatically to over 50% for the first time ever, which we find to be a little bit peculiar. Canadians tend to be very risk averse, very conservative, especially when it comes to our homes. These are, where we're going to live, where we're going to spend our lives with our partners, raise a family maybe. It's our shelter from the storm. So we tend to be very conservative. We don't want to put that shelter, that house at risk by taking an undue risk in our financing. So we prefer fixed rates, even though they do cost a little bit more than variable rate mortgages. It's the cost of insurance against interest rate risk effectively. But lately that changed. And so we want to explore why that is. There may be a lot of reasons for it, but we really want to focus on three things today. The first is the Bank of Canada. We think it's led us astray. Second is market participants, lenders, banks, mortgage brokers, other advisors, focused on the financial advantage of low rate variable rate mortgages at the expense of talking about the risks. And the third is the sort of gambling risk-taking mentality that sort of overtook the real estate market in the last couple of years. So let's go through those in order. The Bank of Canada. In July of 2020, our governor of the Bank of Canada said, "Our message to Canadians is that interest rates are very low and they're going to be there for a long time." It's quite the assurance that rates are going to stay low. Later that year in November, when he was at the House of Commons Standing Committee on Finance, he said, "We want to be very clear. Canadians can be confident that borrowing costs are going to remain low for a long time." He then went on to say that he expected that to mean into 2023. So there's some pretty strong assurances that rates would stay low. That's encouragement for people to borrow money. And where do you put that borrowed money? But into the markets. And the housing market was one of the big beneficiaries of that, as we saw with the rapid house price appreciation that happened in 2020 and 2021 after these statements were made. As the market rises, the fear of missing out takes over. People can borrow very cheaply and they pile into the market. Well, the bank really changed course on us this year, didn't they? They have now raised rates by 3%. And it's expected that next week at the end of October, they'll raise again. And the market thinks they'll raise again in December. Could be that by the end of the year, we have increases this year alone of 4% or even more. Quite the rug pull. They encouraged us to lever up on cheap rates, and then once we all did, they increased rates on us. There aren't a lot of complimentary things you can say about what they've done there. The second one is your advisors, your bank, your lender, your mortgage broker, who really did encourage variable rate mortgages quite a bit through that period, 2020, 2021. Often it was just a simple analysis saying, variable rates are lower than fixed rates, so take a variable rate. You can qualify for a larger mortgage, and it's cheaper for the same principal amount than a fixed rate mortgage. And that ignored the risks. People sort of forgot about the risks. We became a little bit complacent about the fact that interest rates can increase. And so that behavior helped encourage borrowers to focus on the advantages of variable rate mortgages and not think much about the risks. And so it seemed like housing prices kept going up and rates were staying low, and that would continue forever. And neither of those assertions is accurate. Housing prices don't always go up and interest rates don't always stay low. So we kind of lost our way a little bit there. But one thing it also masked is the fact that that rate environment we were in was the anomaly. That's not the historic norm. Take a look at this graph, the historical prime rate over time since 1960. You can see that post-financial crisis, 2010 on, interest rates were very low, abnormally low. And they stayed low for an extended period of time. There wasn't much variability in the last decade. Now, all of a sudden, rates have increased quite a bit this year, but it's just moving us back into a more normal interest rate level. These rates sure do seem high to us because it's been a sudden increase, but when you put it in historical context, it's a fairly normal rate environment that we're in today. We don't know if those rates will come down again, we don't know if they'll go up further, we don't know if they'll stay there, but it's not abnormal for rates in Canada to be at this level. The third thing is the gambling mentality that sort of took hold. Fear of missing out, cheap debt, easy to finance yourself to go buy a house. People were overbidding for properties, people were buying multiple properties, really taking risks that maybe several years ago they wouldn't have taken. And this was encouraged by the low rates and encouraged by participants in the market who were pushing mortgages. And this is costing people now. People now are over-levered and facing higher costs of debt service, and it's a little uncomfortable for many. Now that we're in a more normalized rate environment, maybe that gambling mentality disappears and leaves our market. That would be a good outcome of the higher rate environment, not that there are many. So here we are. A lot of people in variable rate mortgages, more than historically normal. What do you do if that's you? Well, you can stay in the variable rate mortgage. Maybe you have the view that the Bank of Canada's rate hike cycle has come to an end and rates may go down in the not too distant future. That's fine. We're not making that prediction. We wouldn't say that that's necessarily the case, but if that's your view, that's fine, as long as you know, especially if you have an adjustable rate mortgage, where the payments will increase, like they will probably at the end of October if the Bank of Canada raises rates again. But you can afford that. You can handle those increased payments. Then maybe that's an okay decision to make. Another type of variable rate mortgage, though, is the static payment variable rate mortgage. And if you have one of those, maybe your payment hasn't changed yet, but a lot of you are probably hearing from your banks lately about your trigger rate. Maybe you've hit it. The best thing to do, if you can afford to do it, is to increase your payment now. That will help you keep your mortgage on an amortization. If you don't, and the total interest calculation for your payment now becomes larger than the payment itself, that difference goes into principal, gets added to your principal, and your principal balance increases. That's a pretty bad outcome. That will really increase the cost of your debt service over time. So it's best for you to try to not have that happen and continue to amortize your mortgage by increasing your payment. But maybe you can't do that, maybe you don't have the funds, but talk to your bank. They all deal with it a bit differently. Some will allow your principal balance to grow to a certain balance, some will allow your amortization to grow to a certain number, but they're all a bit different. So understand it, go through it with your bank advisor, and make sure you make the decision that's best for you. Some may want to convert their variable rate mortgage to a fixed mortgage. That can be a good decision. It takes that interest rate risk off the table, but it comes at a cost, obviously. You're locking in a fixed rate now. And fixed rates are higher than variable rates, so your payment's likely to increase a bit. But it can be a good decision from a risk management perspective and allow you to sleep at night not having to worry about interest rates every day. One of the things you need to be cautious of, though, is lenders don't tend to offer their best fixed rates on conversions when you convert from a variable to a fixed rate. So you may not get the best interest rate that the market has to offer at that time, which leads to the third possibility, which is you may refinance with another lender. Maybe you're not really happy with your current lender. Maybe they encourage you to take the variable, or you believe they did, or they didn't disclose the trigger rate issues to you and you're just finding out about it now and you're not very happy. It's understandable. Maybe it's time for a fresh start. Refinance with a new lender, and the good thing about that is you can shop for rates then and find the best fixed rate mortgage that's available to you in the marketplace. The challenge with that is you now have to be re-underwritten by that new lender. You have to pass the stress test. You have to provide all the documentation again. So if you're comfortable that you can do all that and pass the stress test, maybe refinancing is an option for you. So here we are, very large number of variable rate mortgage holders out there who probably aren't very happy, wishing that they did lock in at a 2% fixed rate mortgage a year and a half ago, but unfortunately didn't. It points to the fact that, we tend to be conservative. We lost our way a little bit with variable rate mortgages. And part of it is that the industry ignored risk. You mortgage borrowers need to focus on your risk tolerance and the risks you're taking. You need to take control of your finances, perhaps listen a little bit less to the third-party advisors that you have, and make sure you're making decisions that are best for you. That is the reason why we created Frank Mortgage. We felt that there was too much of a focus on making brokers and lenders happy and not customers happy. We've created an environment where you can control your process. We'll give you the advice you need, but we're not affiliated with any lender. We're not on commission, and we give you fair, unbiased advice. If that's what you're looking for, please look us up. You can find our phone number here, or you can look us up online at frankmortgage.com and book a free consultation with one of our free mortgage advisors. So I'm Don Scott, I'm the CEO of Frank Mortgage. This is Frank Talk on Mortgages. Please click like if you like this video, subscribe to our channel so you can participate in more videos, and comment at any time if you'd like to give us some feedback. Thank you very much for watching, and we hope to see you again.